But logically, there are things weakening. I mean, I guess I'm not going to try to ignore it. We know consumers are running out of excess savings, and the job market is getting softer. And we know housing has become a very difficult market. It's unaffordable, and then there's parts of the country where there's huge rise in inventory. Durable goods spending, like on appliances and cars, I mean, it's absolutely tanking. I mean, used car prices are going to fall a lot.
Tom Lee argued that despite predictions of an imminent recession, the economy remains resilient over a year after the last rate hike. He highlighted weakening factors like consumer savings and housing affordability, but stressed that these don't guarantee a recession. Lee noted that rate-sensitive sectors like housing and durable goods could recover quickly with Federal Reserve rate cuts, and pointed to stable credit and bond markets as signs the economy is mid-cycle, not in decline. Lee also cautioned against the consensus view that a downturn is inevitable, noting that markets rarely follow widespread predictions. Drawing on his decades of experience, he emphasized that resilience often comes from unexpected sources, making it essential to approach forecasts with caution and nuance. His perspective underscores the complexity of economic trends, urging investors to look beyond doom and gloom predictions and focus on broader market dynamics and potential recovery drivers.
But here we are, more than a year after the last hike, and the economy's actually doing pretty well. So there's an expiration of the risk of a recession. And I've been following markets for for more than 3 decades, believe it or not. And so I've experienced and covered many recessions. Recessions rarely happen when markets are all saying a recession is imminent. Markets participants aren't that smart. So the fact that so many people think a recession is imminent, and we see it. I mean, we do many meetings with clients, institutional investors, that view recession as their base case. I mean, that would just mean everyone suddenly is a great forecaster of the economy. And as you know, nobody can forecast the economy. We don't try to forecast the economy, but the only reason we think a recession is less likely is because everybody thinks a recession is likely. And there's an inventory correction. I mean, there's been a lot of destocking of excess goods inventory. Those are what's causing the slowdown. But the mistake I think anyone will make is to say, oh, well, that means this is going to lead to a recession. I mean, number one, housing, durable goods, and inventory are all extremely rate sensitive. So the minute the Fed starts cutting, all of those reverse. But second, the bond market, credit markets, corporate bond spreads, quality spreads, things that you think should be blowing out if there was a recession are absolutely mid-cycle. And look at the stock market. I mean, so I would say if someone is saying that they think a recession's imminent and they're bearish, they're shouting at the market. I mean, I don't know anyone who's made money. I mean, it's not very hard. What's interesting is, that's a compounded rate of like 15% a year.
Okay.
I'm sorry, 15% roughly in earnings and another 5% or so from multiple expansion. And I'd say let's just do a reverse interval. In 2008, when I was at JP Morgan, S&P earnings the year before was expected to be $60. So into the GFC, like the high watermark for earnings was 60. And there were people that said the S&P wasn't even going to make $60 again for a decade. That's actually healthy because the larger scale miners, as you're pointing out, can be quite innovative, and so I think mining is actually incredibly important. I mean, mining is important for Bitcoin. I mean, there is no Bitcoin without mining. And the miners, I'd say it's been trickier as equities because I'm thinking about them as stocks because they are essentially beta to Bitcoin.
Interesting. So the incoming president's rhetoric around Taiwan, they're going to have to pay for their own defense, which means Taiwan, I think, is going to wind up buying F-35s and Patriot missiles from the United States to show that, we're willing to play ball, which is going to infuriate the Chinese. So you start to play this through and wonder how the whole thing shakes out, which has been the existential risk to Taiwan Semi and maybe Nvidia the whole time.
What about semis? Yeah. We mentioned Nvidia, it's, pushing Apple right there on the top of the market cap chain. It obviously has had an incredible run, but not every stock is in Nvidia in this market.
No.
How are you judging the semis?
This is the one place where I really think you've seen, and this has really been true all spring into the summer, into the fall, where you've seen leadership really fracture or split. We know how good the Nvidia chart is. We know how good Broadcom has been. Where's AMAT? Where's Lam Research? Where's ASML? Where's Samsung? It is, of what is perceived as leadership, I think it's the faultiest of that. It's the weakest under the surface. Only 25% of semis are actually above their 200-day moving average here. You do get some good seasonality with semis the next 4-6 weeks. I think if you got a bounce, I'd be more inclined to fade that bounce in semis than I would be chasing.
I asked you earlier about Berkshire selling Apple, so let me flip it and ask you about Nvidia now and the inclusion in the Dow and how you're thinking about that based on what you've seen through the years.
Yeah, I mean, obviously, on some level, the inclusion of Intel previously and not having a play on Nvidia, which is 7% of the S&P 500, probably just made the Dow feel a little bit unrepresentative of the economy right now. Now, you could definitely make the case that it's just grabbing onto a high momentum play way after the fact, after its greatest gains. I was just looking at the Nvidia versus Apple equation in terms of, market cap neck and neck right now. Well, Nvidia has about a third of the revenue in the coming year and about half the net income. So you could obviously say it's a more expensive stock, but it's growing so much more quickly. So in the short term, first of all, there's no brand new reason to buy a stock because it's in the Dow. History says that's not at all a reason to buy. There's not a lot of money indexed to the Dow. It's much more about, the way that it's validating its current role in the new tech economy, which we sort of knew already. So again, I don't think it's a sell the news. Maybe it's a buy because of the capitulation on Intel. But at this point, it seems much more about the Dow trying to stay relevant.
Let's take a check on shares of Nvidia this morning. Piper Sandler naming the stock a top large cap pick and saying it's a must own for the ramp up of its Blackwell chip, rating that stock an overweight with the price target of 175. The price today, $148.17.
You mentioned some of the hyperscalers, guys. Nvidia, a couple nice notes. One is Piper makes it a top pick. And then this Melius note is pretty interesting. Ben writes this goes to 185. He says, we're even more excited about Blackwell than we were before. Giving up on Nvidia with Hopper, meaning the current cycle, Ben says, is like giving up on Apple after iPhone 1 or 2. And they've got some fresh estimates, David, on hyperscaler CapEx. 282 is their number.
282 billion over what period of time?
Year on year. It'll be up 24 year on year. And that's including Oracle, Amazon, Meta. I'm not sure how it compares to some of the Morgan Stanley numbers we got.
That was over 100. Yeah, I mean, right. They were 300. That's right. Yeah, actually, I got to check the numbers. Something has been interesting, though, that I've sort of been trying to focus on. There was an information story from last week. I also listened to this podcast that Mark Andreessen and Ben Horowitz do. It was actually done prior to the election, but it has nothing to do with that. It was about, or at least they raised the idea that the progress of the large language models, particularly at OpenAI, is slowing dramatically from one model to the next, so to speak. And the information in the story also talks about Orion. That's the upcoming flagship model, I guess its code name there. Its performance did exceed that of prior models, but the increase in quality was far smaller compared with the jump between ChatGPT 3 and ChatGPT 4. Those are the last two models, of course. And Andreessen said the same thing on that podcast. I just flagging it because it's kind of interesting. Are they running out of data? What is the reason? Is it true? Is there really a slowing in progress? Because that wasn't expected. if in fact, and they're using as many or more CPUs. So it's not like it's a chip-related issue. It simply may be either a data-related issue or unclear, certainly for me unclear, Carl. But that would have big ramifications if the progress suddenly stops.
I know. The other, and not to get too far afield from what you're saying, Andreessen tweeted the other day, called America an economic coiled spring.
Saw that.
We should be growing at least 4 and ideally 6 to 8 plus % on GDP. He says growth has been brutally suppressed since before I was born. That would be interesting. But then we get back to these. We had these discussions during the first Trump term, and that is you need people. And how are you going to get that kind of growth without people?
Right. Well, maybe it's going to be robots.
Generative AI.
Yeah.
That's how you do it.
But maybe if it stops progressing, Sarah, that's the point. Listen, I'll listen to Mark Andreessen and many other experts on this, certainly Jensen. I have no idea, but that story, citing people at ChatGPT as the sources, and then Andreessen just basically saying it on the podcast as well, I thought was interesting.
It is because we all think it's on a one-way ticket, faster and higher.
Correct. I mean, and by the way, the rate of change will only increase exponentially. So, it perhaps bears watching.
Tom Lee argues that fears of an imminent recession may be overstated, pointing to resilient credit and bond markets and the potential for recovery in rate-sensitive sectors once the Federal Reserve adjusts policy. While acknowledging economic challenges like declining consumer savings and housing struggles, he highlights the importance of looking beyond bearish sentiment to assess the broader economic picture. Lee's analysis reminds us of the unpredictable nature of economic cycles and the dangers of over-reliance on market sentiment. His perspective encourages a balanced approach, recognizing risks while staying open to recovery opportunities. Do you think widespread recession fears can influence economic outcomes? Why or why not? How do you approach investing during periods of economic uncertainty?